Hello, everybody. Today is Sunday, the 12th of June, 2011, and this video will talk about the volatility within the silver market. And volatility, at least in the way that I like to measure, tracks how large one movement is from the other. And I use a fairly simple calculation by taking the highest level of a particular candle and I subtract it by the lowest level. That gives me the difference from top to bottom, and then I divide this by the lowest level again, and then this would give me a percentage level. For example, if the market trades between 50 and 40 in a month, then I would take 10 and divide 40, that would be 25%. And if you have situations like back in 1980 where you go from about 32, 33 down to about 11, that's about 200%. It's actually 160% or so because it goes down to in here about 13 or so. So you can get some really, really wild moves within the market. Now, normally volatility occurs when markets are really breaking out and going through their correctionary phases, as well as when markets bottom. Well, not in here. We'll go over that. Well, right now, because the average movements back in here were the lowest on this chart, where I don't think that they could have had higher volatility because higher volatility would have either meant that they would have had to break the $7 resistance. I don't think that the market controllers for this particular market wanted it at that time frame. And at the same point, the higher volatility could have brought it below 4. And, well, I don't think that would have been possible. In my opinion, higher volatility would have woke a few more people up. And, well, they didn't want that to happen. That's simply an opinion base. So now let's go over the volatility on different time frames. The one that I've been showing most of the time has been on the hourly chart, where the blue line represents the average moves on an hourly basis. And that spans 2 days, where the orange line would span 10 days. So when the market was crashing, the average moves on 3 different occasions were that of 2% per hour. Now the key word is this is the average move. So when you have an average of 2%, that means there's some at 1% and 1.5 and 2.5 and 3 and 4. Those are some pretty serious moves in just an hour period. And I think what's important is to see what happens the next time we get up to this level, because it seems as if it's a matter of when. And I think that at one point, that high volatility will bring upside action, probably to a scenario like a COMEX collapse, paper collapse for sure. And you can use different patterns in here. And I was talking before how this was a double bottom, and well, it surely worked kind of, or double top, sorry, and it worked kind of perfect for the normal price objective, because the difference of going from 2% to 1% is losing half its value. Therefore, going 1% to 0.5% is losing half its value. And now I was talking, well, maybe we'll build this inverted head and shoulders. Well, maybe we won't, because it's now just starting to slide towards the downside. So one chart's telling us that volatility may go lower. The next one, not so much. This is a daily time frame. The blue line represents the average moves on a daily basis over the last 20 days. The orange line over the last 100. And this chart goes back to the fall of 2008, where the average moves were 9%, and it started to slow down as the market was finishing its bottoming process. And within this orange line, or the 10-day move, or the 100-day moving average, resistance, resistance, got above it, and then as much as it went above it, it went below it, above it, below it, above it, below it, and it had a huge break above it. And it's back to an area of the 100-day moving average. Major resistance was 4%. That's where we are now as possible support because these moves in here brought the big rise of movements that see the market go from 50 down to 32. Over the last few weeks, the market has been very boring, and because the market has been very, very boring, the volatility has been much, much lighter, which is why it comes down to this point. If it continues to be really, really light, then it'll break through this and then maybe find a settling point, maybe at 3%. That's difficult to say. But at the same point, the next chart, which is the quarterly chart, I couldn't put any years on here, unfortunately. However, this is the 1980 high. And as I was mentioning about 1990 and even 2000, the lower volatility on average, this is over a 2-year and 10-year period. The blue line is the average moves over 2 years on a monthly basis, which was only 6 or 7%. Back when silver was $3.50 an ounce. Because normally when it goes down so low to fire sale prices, it's very volatile because the prices are cheap, as we see on the daily chart. It was at 9-10% because silver was $8 an ounce, $9, $10. Fire sale prices, they don't last long, but they did back then. So today, if we have a situation where we fall to say $20 per ounce, just like we did $8, it probably wouldn't take long to get it back up to 26 or 27, maybe within a week or two. But as far as this chart's concerned, we have previous resistance now becoming support, which is roughly at around this 15% mark. The 2-year average is meeting up with the 10-year average, and the biggest moves in here came during the 2008, 2009 situation back in here. That's what this is. And we've already had big movements before. As I was saying within this last chart, this was over 100% candle in here. And now if we have that big move that I've been expecting, it seems as if it might be happening relatively soon. Alrighty, thank you for watching. If you have any questions, please leave them down below and have yourself a great day. Bye-bye.